US President Joe Biden's forging ahead with plans to push through a $1.9 trillion economic stimulus relief bill to help steer the US out of the COVID-driven downturn. Will it work? What will it do? And how will Biden go about implementing the strategy with many, including Larry Summers, a card-carrying Democrat who was Treasury Secretary under Bill Clinton and a key Obama-era economist and someone who would have worked very closely with the then Vice President Biden? He was saying that $1.9 trillion is too big and will bring about inflationary pressures not seen in a generation. Well, to help us through this is Christopher Vecchio, senior strategist at Daily FX, who joins us now on the line from New York. Chris, good to talk to you. First of all, put it into context. Why is this stimulus necessary?
Well, thanks for having me, Jeremy. It's good to talk to you again. And, this is necessary for the United States because we're still reeling from the coronavirus pandemic. 10 million Americans are still without jobs. And there has been this notable K-shaped recovery. We talk about shapes of the recession. Will it be a U-shaped, a V-shaped, a W, a double dip? What we've seen here is that the rich have gotten richer and the poor have gotten poorer. In fact, when you take a look at the top, say, 10% of income earners relative to the bottom 50%, they've gained about $3.7 trillion during the pandemic globally, while the bottom 50% have lost about $3.4 trillion. And as we know, those bottom 50% of workers, they're workers. They're not capital owners. So we need support for, the everyman. We need support for families. We need support for small businesses, which is why I find this criticism from Larry Summers so confusing, because this is the same Larry Summers who thought getting rid of Glass-Steagall was a good idea, which allowed commercial and investment banks to commingle their activities. This is the same Larry Summers who helped craft the lowball Obama stimulus plan using his cachet to influence that decision-making. By the way, one of the reasons why Biden is so ignoring him. But Larry Summers' criticisms in recent years have probably come from a more jealous place. He was beaten out by Janet Yellen to be head of the Fed a few years ago. And of course, then he became highly critical of the Fed under Yellen. And just now he was beaten out by Yellen to become the next Treasury Secretary. He was seeking to return to that post. And now he's critical of Janet Yellen's point of view. I just sense that for a guy who said things like women aren't good at science, a real jealous streak around Janet Yellen. And I hate to go to this place, but Larry Summers really doesn't have good standing. I know you say he's a card-carrying Democrat, but he doesn't have good standing in center-left economic circles these days. He doesn't have good standing in the Democratic Party because he's seen as one of the people who has stood in the way of more economic progress, more stimulus relief in the past, and once more again today.
Okay, so you've explained what it's aiming to achieve in as much as you think that it tries to redress the balance between those that have lost out and those that have gained so much during this last 12-month period. I'm interested to find out as well how it'll be rolled out and over what period will it be released. Clearly, you don't just dump this sort of size of money onto the market in one go. It's got to be targeted. It's got to be measured. He's got 4 years, of course, before he then has to go back to the electorate to be reelected if that's what he wants. So how long is it going to take to roll out this sort of money and where's it going to go?
Sure. So I do think we're going to see pretty much close to the 1.9 trillion, if not all of that. Democrats do have the votes in the Senate to make it happen. There are some things that may not make it through, like an increase in the minimum wage to $15 an hour. But that is something that's long overdue. The federal minimum wage has not moved in 20 plus years. When I first joined the labor force, it was $7 and change as it is today. So that obviously is something that will be up for discussion, but I don't know if that makes it into the current bill. Instead, we're talking about these direct checks to Americans, particularly lower income, middle income Americans, those consumers across any economy really, who save less, who put most of their income back into consumption. That's the kind of thing that will help boost aggregate demand very quickly, will help bootstrap the recovery. There is some concern that if you send out stimulus checks to higher earning individuals, they will just put it in their pocket and it won't help the economy by sitting in a bank savings account. which, by the way, is an interesting critique of supply side economics or trickle down economics. That's a discussion for another time. I do think that the plan here, though, for this particular tranche of stimulus is to make its way through the economy in the next 6 to 9 months, really to help boost the 2021 GDP figure. And this won't be it. Joe Biden is seeking to do an infrastructure spending program. Infrastructure Week will maybe finally be here, and that could come in the second half of this year, which would help pave the path for more continuous high-run growth heading into 2022. Right now, where things stand, we're looking at perhaps 5.5%, 6% annualized growth rate for 2021, even without any more stimulus. So with $1.9 trillion, that would certainly put icing on the cake in that regard.
Okay, so that's illustrating a little bit of how it's going to affect growth. What about jobs? Treasury Secretary Janet Yellen seems to think that the US can return to full employment next year if the stimulus is passed in full. I mean, I can't think that someone like Janet Yellen works to an audience, but what is the threat, do you think? I mean, illustrating the risks if this stimulus is not given the green light.
So I do think that part of the stimulus appeal is that it helps provide a more certain environment for consumers. One of the worst things that occurs during a crisis is uncertainty. People don't have confidence, and that's when people stop spending money. They stop making investments, and we see the credit cycle freeze. We see velocity of money fall. The idea here is, with a lot of the stimulus spent upfront at helping with vaccine distribution, with helping ensure that we have enough testing and tracing going around the country to quell further surges, to get hospitals the PPE that they need to make it through the next leg of the crisis. The idea here is that if we can stem the bleeding, if we can suture this wound, then the jobs will be able to come back sooner than later. And there is this idea that the longer people stay unemployed, they become permanently unemployed. There is a permanent erosion of skills that are lost. Businesses, instead of just being temporary closed, stay permanently closed. And the longer we go on from the onset of the crisis in March 2020, the higher those permanent unemployment, permanent business closures become. So right now, the goal is stop the virus. Once we stop the virus, we can reopen the economy. These two things are not mutually exclusive. They go hand in hand. And I think that's where the stimulus is going to be aimed up front. So unemployment benefits, making sure that people still have that kind of support, getting stimulus checks to families directly, opening up more funds, grants, low interest, if not zero interest loans to small businesses, and then ultimately beating this virus. And that's first and foremost. Now, the one, fly in the ointment here, Jeremy, as you've seen across the pond, is that there are variations and mutations to this COVID-19. And so right now it's really becoming a game of, can we inoculate enough people before the virus has a chance to make the next jump? Because the more people it infects, the greater the chance that it experiences that genetic drift, and we get a new strain akin to the South African strain or the Brazilian strain, one that has a much greater impact or ability to circumvent the antibody platforms that have been produced by companies like AstraZeneca, Pfizer, BioNTech, et cetera.
But my understanding is that this $1.9 trillion is for the economy. It's not going to go towards that all-important fight, as you say, against coronavirus. Is that correct? Or is part of that part of the fight against COVID?
Oh, part of it is for the fight against COVID. That's absolutely in there. Making sure that we have distribution channels set up across states, making sure that we can surge a vaccine distribution where needed. Quite frankly, it seems that there wasn't much of a plan at the federal level under the Trump administration, which, that's not necessarily a Trump thing. That's more of a Republican Party mantra. They don't believe in, a strong federal government. They think that states' rights, if you will, the state should be able to control certain things within their own territory. So that's, again, not a Trump issue. It's more of a party ethos. And so thinking about how Democrats operate, where they have really no problem using the cudgel of the federal government, they're going to try to get this up front. But we need to think of this less as a stimulus plan and more of a rescue plan, right? We have to stop the bleeding first. We need to suture the wound, and then we can think about the infrastructure in the later half of the year as the actual stimulative impact for the economy.
Okay, so we've covered growth, we covered jobs. I want to talk about average earnings. You spoke there about the base rate of earnings hasn't changed in many years. But what about average earnings? Do you see them beginning to creep up now? Do you see that there will be more opportunities to pay people more? I mean, clearly there could well even be a skills gap. If you're talking about full employment at some point, and you're talking about an economy that's moving into relatively new areas like technology and so forth, you might find a situation whereby employers are going to have to increase marginally, large margins in terms of enticements for a lot of staff into the workplace in order to be able to fill the skills gap that is going to grow unless people are being rewarded properly. Do you see average earnings creeping up at a rate that might maybe lean towards the Larry Summers idea that things could spiral out of control?
Well, I think if we look at the average hourly earnings data out of the United States right now, you're going to see some high figures, but that's driven by two particular issues. One, a base effect, because year over year now we're going into a period where a lot of lower income people along the spectrum lost their jobs. People in, white collar office jobs were able to move and work remotely. People in blue collar, in person service or manufacturing or retail industries, they were not. And so when you take the 10 or 15 or $20 per hour jobs out of the labor force, and those are the people who are not gaining work, of course, then the individuals who are still being hired are the ones who are making, high five figures, low six figures, maybe even more than that. So this is, in part one, because of the calendar seasonality effect here, but two, because of the composition of jobs themselves. So if we have a robust, broad-based recovery and this K-shaped recovery narrows and the difference between high income earners and low income earners narrows, then in theory that means lower income earners should retain more of the job growth moving forward in the future. And that's going to actually drag down the average hourly earnings figure. Are we worried about inflation right now? You know, every time I hear people complain about the Fed and inflation, I feel like, the Bank of Japan and the ECB policymakers get on the phone and have a laugh with one another. The BOJ hasn't been able to generate inflation in 20 plus years. The ECB has been struggling for the past almost 15 years. If the Fed somehow, some way is able to generate inflation, certainly the BOJ and the ECB will be calling because they have not been successful. This environment with fiscal stimulus, with monetary support, it does speak to conditions for higher inflation, for higher growth. But we haven't seen that yet. And instead of worrying about effects that could come down the road, let's deal with the problems that we actually have right now. There are 10 million people still don't have jobs. If the worst thing that happens is that we see upwards wage pressure after the largest income inequality gap since the 1920s, perhaps that's not a bad thing.
One of the things, of course, that people do, those that do have money, they invest in the market. We've seen record highs recently again for all the major Wall Street indices. And much of this, my understanding, is based on the fact that the stimulus bill is coming through. What about corporate earnings? How do you see corporates benefiting from all this?
I do think that stocks are going to have a really nice year. I think that corporate earnings just improve as the vaccine rates go up. If we're looking at a situation where more Americans, more people in general out in the world consuming, that means trade's going to increase. I think right now we've gotten past the bottom. Now, does that mean we're going to continue to see, explosive growth in the stock market? No, not necessarily. We could see earnings increase and PE ratios come back in a little bit. And that could lead to a period of sideways trading in stocks for a few weeks or a few months as we recalibrate expectations to a more, normalized future. But I do think corporate earnings have a really promising outlook for this year. Going into next year, the revisions that have come through in recent weeks have all been on the upside. And so I think that more and more companies are looking at the environment and foreseeing, a resilient U.S. consumer with a lot of pent-up demand. And I think stocks are trading at all-time highs for a good reason. Yet you have this mix of low interest rates, of a lot of fiscal stimulus, of a rebound in consumption. Yes, things today aren't so great, but markets are forward-looking. And in the future, things certainly look better than they have just a few weeks ago.
I want to return to the point about inflation, if I can, and once again bring in that Larry Summers comment at the top, and take a look in the context of not inflation in terms of average earnings that we've already spoken about, but the annual core PCE, the price index recently, I think, came in at 1.5% in December. That was ahead of the 1.3% expected. Is there a danger that this could get the wrong side of target in order to start to bring about concerns within the US economy? Because no one wants rampant inflation.
Oh, of course not. No one wants to see their price power erode. And I do think that the Federal Reserve is about to go through a period where they're going to have to prove how resilient and committed they are to their low rate regime. Again, we saw some really harrowing price pressure data last March, April, around the initial lockdown when we saw 20 million Americans lose their jobs. So again, statistically speaking, we're going to enter a period now where we have that base effect, where because there was such a big drop off last year, just even by treading along at current levels, the measurement from where we stand today to trough is going to be that much more significant. And that's going to lead to a higher rate of inflation. It's possible that we see inflation north of 2% in one of these coming months, and the Fed's going to have to look through it. And that commitment to looking through that higher inflation is going to help curate what has been the most significant environment for the market, which is the impact of negative real yields. We have a situation where inflation expectations have gone up, where we're now probably going to see near-term actual inflation readings rise because of this base effect. But because of the commitment from the Federal Reserve, the ECB, BOJ, BOE, and all the other slew of acronym central banks out there, we are going to see low interest rates maintained. I mean, the RBA, for example, has said they're keeping rates low through 2023 no matter what. And pulling away from that would cause a lot of panic in the market. So inflation expectations, inflation rates go up, negative real yields develop. They become entrenched. If you have negative real yields, you don't want to hold fixed income. Why would you want to do that? Your income stream's fixed, and you're seeing that your ability to generate real returns is diminished. So what do? Well, you move into things that have growth potential. You can go into silver or copper. And if you like the corollaries there in the FX space, that would be the Mexican peso or Chilean peso. You would go into something like real estate. You go into equities. But the whole purpose of this low interest rate regime by the Fed and other central banks is to shift investors' risk preferences, to force people to say, I need to make a required rate of return each year, and this asset allocation no longer dictates that. I need to take more risk. I need to put more money to work.
It's very difficult, isn't it, when talking about the Federal Reserve? I mean, they are faced with a very difficult decision because clearly they cannot allow prices to get out of control. They've got to act. But I think the point you were alluding to is the fact that there is this massive debt pile, isn't there? And the Fed can't be seen to be raising interest rates when people will otherwise feel so much pain if interest rates were to go up for their loans. Very difficult position to be in, the ultimate rock and a hard place, isn't it, for the Fed? When do you see interest rates starting to creep up then?
Not this calendar year, not next calendar year. If the Fed is going to stick to their word, and in this world where we have low trust in institutions, I think the Fed cannot contribute to more instability. Think about Bitcoin, for example. Why do people hold on to Bitcoin? There was a great article yesterday by Bloomberg's Joe Weisenthal about the appeal of bearer assets right now. The baseball card market is on fire. So is art still. Same thing for wine collections, because bearer assets have a greater appeal in a world where you do not have trust in financial institutions. And so the Fed can't contribute to that lack of trust that's already out there in the system. They can't all of a sudden turn on their word and say, we're going to keep rates low for a few years. All of a sudden, what? Game over. It's next week, next month, next 3 months, we're going to be raising interest rates. It's going to cause a dramatic recalibration in investor expectations. It's one of the reasons why gridlock in Washington, D.C. isn't the worst thing in the world, because nothing's going to get done. So you can keep a pretty stable outlook for the near term. Policy's not going to change, so you don't need to worry about corporate tax rates changing or different areas of investment or tax credits rising. Just one last point to make on this, Jeremy. If we're talking about inflation and the Fed being in a particular spot in the world, they absolutely need to think about the debt, because one of the hallmarks of the Obama presidency, as Joe Biden will remember, is austerity. Now, austerity was based on that Reinhart-Rogoff study that ultimately proved defective because of an errant cell in an Excel spreadsheet. But that was still something that the Republican Party in the United States wore as a badge, that we need to cut spending, we need to reduce debt and deficits. Will that be something that Republicans use as a cudgel after this $1.9 trillion stimulus, making more efforts to get infrastructure done later this year more difficult? Certainly possible.
Just wanted to open it up a little bit and take a look at the wider picture, because the US economy, of course, in fact, it is still the largest economy in the world. And we are expecting some sort of fireside glow, if you like, on this side of the Atlantic and in other developed markets. Do you think that this rising tide in the US is going to see all boats lifted around the world, certainly in the developed markets that work so closely with the US?
Absolutely. I mean, I just think about North America, for example. Mexico, 30% of their GDP is directly tied to the United States. 80% of their exports go to the US. Canada, 20% of their GDP comes directly from activities with the US. 70% of their exports go to the United States. The United States coming back off of its feet, consumers consuming more will be good for its direct geographic neighbors, but will be good for global trade. It will be good for these Asian economies that have significant manufacturing bases that have seen growth and taken market share during the pandemic. Vietnam, South Korea, even China stand to benefit in a world where the United States is on its feet. Same thing for Europe. If Europe gets off of its feet, that's good for the UK, that's good for China. And so getting the United States, getting the EU up and running again, the world's largest economy, the world's largest single market, will be crucial to getting global growth rolling again. But more importantly than that, I think that we need to consider the fact that these developed economies have been, I don't want to say hoarding the vaccines, but the emerging market economies are still very exposed. You're not hearing a lot of news about vaccine supplies being secured for, countries like India or Brazil. And if there are quantities being secured, they're very, very minimal. And so if the world really is going to grow again, yes, we need the US and the EU, but the fastest growing economies in the world are in Latin America or in Africa or in Southeast Asia. And unfortunately, they remain exposed right now because they do not have access to vaccine supplies.
Let's take a look at what happens in the foreign exchange markets and the dollar specifically. Is this good for the dollar, or what will happen, do you think, on the foreign exchange markets?
I think this is actually pretty bad for the dollar. For several months now, I've been beating the drum that this combination of the Fed's low interest rates alongside an increasing U.S. debt and deficit has curated an environment of negative real yields. And when we take a look at the charts, unfortunately, we can't do this visually here, but if you were to pull up a chart on your screen for listeners at home and look at the trend line in the DXY index, the dollar index, off the lows that we had back in 2013 all the way up to 2018, you'll see here that we've made a pretty significant trend line break here. And you may notice that there also appears to be a little bit of a double top in play. This to me speaks to an environment where technically we have a really weak situation, a fundamentally bearish situation as well, with this combination of negative real yields emerging thanks to low interest rates and higher debts and deficits. And so I think this is bad news for the dollar. I'm thinking if there's an allegory, it's like it's mid 2009 right now in terms of the market cycle. We've just gotten to the other side of the crisis, so to speak, now that the vaccinations have begun. We have a long period of time of fiscal support ahead of us. We have a long period of time of monetary support ahead of us. Does this mean that things are irrationally high priced? Probably. Does that mean that could continue? Probably. So I think this is a weak dollar means higher equities. It means higher precious metals. I do think that silver here has a lot of room to run. I will say a little surprised that silver has trailed gold, but then again, silver does have more economic uses. And so in a world where demand for just consumables is down, of course, silver may have a lower demand on that end. But moving forward, in electric vehicles, solar panels, silver will be in higher demand moving forward. And an environment just like 2009, 10, early 11, that was proved explosive for silver prices. So I like silver higher, like copper higher. I think the dollar will continue to weaken this year. It is one of my top trading opportunities of 2021.
Okay, Chris, we'll have to leave it there, but thank you very much indeed for joining us with this look at the implications for that massive stimulus bill. That's Christopher Vecchio. He's Senior Strategist at DailyFX. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.